Welcome to the Video CPA. It's good to be with you today. I'm Michael Scott. I've been a CPA for over 45 years, I believe. I've been preparing tax returns for over 46, so somewhere in there. But it's good to be with you. We're going to talk about data retention for tax. I used to get these questions all the time when I owned my own practice, and when I was with PricewaterhouseCoopers, we'd get the questions too, only they were for much bigger firms then. So let's get into this. We've got the disclaimer and we've got the educational disclaimer here. Let's get into what's called Revenue Procedure 9825, written back in 1998, so it's been around for a long time. Written for companies or addressed to companies with over $10 million of revenue. You might ask, well, why am I even talking about this? Because most individuals don't have over $10 million of revenue on their 1040. Some do, but most don't, okay? But this kind of sets the standard for record retention, especially for record retention that's not a hard copy record retention, because this deals with record retention that is where the records are stored in a database online in what the IRS calls machine sensible format, okay? So it basically says that you have to keep these records for as long as the IRS is interested in, okay? And you have to keep whatever the IRS is interested in that supports your tax return. But then it goes on and it says, hey, and if you're keeping your records, even though you're less than $10 million in revenue, if you're keeping your records on a database, an electronic database, this applies to you. And then I don't have this on here, but it also goes on and says that if you're making calculations in a computer or in a machine sensible type format, this also applies to you. Now, in 1998, there were very few individuals that were doing their taxes using TurboTax or TaxSlayer or whatever. But today, there are a lot of people, and that tax software makes calculations that are used in the preparation of your tax return. So I would say now that Revenue Procedure 9825 is applying to a lot of people. So just be aware that you're probably falling under 9825 when you're keeping your tax records or retaining them, unless you're doing everything in hard copy. All right, so let's look at some of the other provisions of 9825. They're basically saying that you need to keep your records as long as they're of interest to the IRS, and that they can be kept in digital format, that if you're scanning them in and stuff, you can scan them in and you can destroy your hard copies. And so that's a big advantage for a lot of people and a lot of companies that don't want a lot of paper around. And it talks about if an auditor comes in, you don't have to put them on your machine. You don't have to let them get into your QuickBooks, for example, on your machine. Or if it's SAP, for example, because I worked with the SAP for a long time doing SAP work with the data retention tool. And when I was with PricewaterhouseCoopers for 7 years, working with Revenue Procedure 9825, and showing we were actually implementing what's called the data retention tool for SAP into some very large companies. And we actually taught the IRS computer audit specialists on 3 different occasions on how to use what was called DART, the data retention tool for SAP, and Revenue Procedure 9825. And so that's where I became familiar with it, because I've worked with it for 7 years. But so you don't have to allow them on your computer system, but you do have to give them printouts, for example, if they want printouts. Now, they would just as soon have electronic data so they can look at it faster. But what's best really is to give them something like a QuickBooks accountant's copy. Then they can get into everything that you've done, and they can see all your mistakes and stuff. So if you do that, you better make sure your records are in good shape. But QuickBooks, not all QuickBooks versions, or at least it didn't used to be, have accountant's copies, have the ability to produce an accountant's copy. So if you've got a farm, for example, or some other type of Schedule C business, you better have a QuickBooks version that can produce an accountant's copy, because when you go to your CPAs or whoever your accountants might be, it's much easier to take them that accountant's copy. They can input that into their own machine and update it, correct it, make sure that your QuickBooks file is tying out to your tax return that they're preparing for you. And then you've got everything in line so that if you get audited down the line, you don't have QuickBooks that says one thing and your tax return that says another. So that's very important for you to do, is have have your tax return and your financial statements, your QuickBooks congruent, so that the QuickBooks detail supports the tax return. Okay, and by keeping that either in a database or keeping hard copies, you can do that. The problem is if you keep that stuff and you got to keep it, but if it doesn't support what your tax return says, you're stabbing yourself in the back. So make sure it's in good shape. All right, let's go ahead and talk about the IRS periods of limitations. They used to call this a statute of limitations, but let's talk about it. So in general, your period of limitations for tax purposes is going to be 3 years from the filing date of the return plus extensions. All right, so generally you got 4 years. All right, let's just use a ballpark of 4 years, and that is true for most records that support your tax return. So that's the rule of thumb: 4 years. Just keep your stuff for 4 years, then you can get rid of it. All right, 3 years from the filing date of the tax return plus extension. So that means like you're in 2020 right now. You're filing your 2020 return. That return, if it's extended, may not be filed until October 15th of 2021. That means you've got to keep your tax return for 3 years from October 15th of 2021. And you have to keep the supporting data for that tax return that long. All right. So just be aware that it's not, it's from the date that you file that tax return. Okay, and you'll notice there it also says 4, 5, and 6. If it meets any of those, it doesn't apply. And those generally are situations where you've understated your tax dramatically, 25% or more, or you've not filed a tax return at all, or you filed a fraudulent return. So if you've done these things, you need to keep your records indefinitely. And if you've done these things, you may think, well, I don't want to keep my records indefinitely because I've filed a fraudulent return or something. But and if you don't keep them, the IRS is just going to impute what your taxes should have been, and it may be much higher than what you would have filed for. So, but anyway, if you're breaking the law, you've got to keep them indefinitely. But most people don't do that, so we're looking at a rule of thumb of 4 years for most records. Okay, there are some records that need to be kept longer. Let's talk about those. Those would be property type records involving fixed assets or land or something like that. All right, and generally on those things, the IRS says, hey, keep them until the statute of limitations or the period of limitations expires from the date that you dispose of them. Okay, so if you've got a piece of land, or well, let's say it's a rental property, and you dispose of that rental property 10 years after you buy it, well, then you should keep all the documents on that rental property and where you when you purchased it, when you sold it, for 3 years from the date that you actually got rid of it. Okay, for that tax return, for that year's tax return, which is probably still 4 years. Okay, so the fixed asset data needs to be kept for a long time, and sometimes it's unreasonable if you've got a rental house and it's depreciated over 27 and a half years to keep that stuff for 27 and a half years. And the IRS could ask for it, but people move around. I mean, it's hard to keep that data. It gets lost. But what they will ask for, and I haven't seen them ask for something for a source document that's that old. What I have seen them ask for, though, is the depreciation schedule, where they're depreciating that property. And that depreciation schedule has the date of purchase on it. It has the amount that's being depreciated, which could be the cost of the property, or it could be something that costs less something. And it shows the amount of depreciation that's taken every year from the time that it was purchased. And then it shows the gain or loss on it. And, the depreciation schedule doesn't show the gain or loss, but you can use it to show the gain or loss, or to calculate the gain or loss. So on your fixed assets, you need to keep that stuff longer, and you especially need to keep your depreciation schedules that are part of your tax return. Now, unless you have a rental property, or you have a farm, or you have a Schedule C business, you're not going to have depreciation schedules on your tax return for the most part, okay? But those things need to be kept longer. And your old tax returns should keep them for 4 years. I'd keep them longer, especially if there's depreciation involved in that, because those schedules might be part of the tax returns. So keep those. Sometimes they're kind of fun to go back and look at and see how much money you were making 20 years ago. And see what inflation's done to our country. Data retention formats, we talked about that a little bit already, but you can keep it in hard copy, buy a file cabinet, put them in a folder for each year and keep them in a file cabinet. If you don't want paperwork around, get a good scanner and scan them in. But when you scan them in, you got to have some place to put them on the computer. So you need to buy a little database system of some kind, and I recommend File Center as your database. We're using that now in our practice. Very easy to use, very intuitive. It does quite a bit for you, and fairly inexpensive, actually. So I think you'll like File Center. Just go out and Google File Center and look and see what it costs and what you think. But it's pretty good software, and like I say, if you're going to keep something in machine-sensible format, well, you need to have something that organizes it, and File Center will do a good job of that. All right, thanks for watching. If you're interested in tax preparation, we've got a free class out on our the Video CPA's Targeted Tax Training site, which is our actual teaching site, and it's good for continuing education credit if you're an old agent, or if you're part of the annual filing season program. It's a free course, so you can take it out there. Or if you just want to learn more about tax preparation, we have a tax preparer certification program. So thanks for watching, and I'll be with you next time.